On May 14, 2026, the President of the United States stepped onto Air Force One and headed for Beijing. He did not travel alone. NVIDIA's Jensen Huang joined the trip. Elon Musk was present. A group of America's most influential business leaders filled the cabin. Cameras captured every moment. It appeared to be a display of American strength and unity. Yet nearly every report covering the visit included one quiet but telling detail. The United States had requested the summit. China simply agreed to host. That single fact reveals more about the current state of tensions than any headline figure. And the number dominating conversations, $17 billion, sounds like a significant American success until you examine what it truly represents. If you enjoy breakdowns that go beyond surface-level announcements, hit like and subscribe. We examine the actual data and long-term implications every week. By the end of this video, you will understand why that $17 billion announcement may not represent a victory at all. It could instead mark one of the most costly setbacks presented as progress in recent American economic history. And there is a Taiwan element toward the end that could render the entire agreement irrelevant almost overnight. Stay with me. How the situation developed. Let's step back to April 2025. The administration launched what it called Liberation Day, a broad package of tariffs on Chinese imports that reached as high as 145%. The White House message was clear and confident. Officials claimed China held weak cards while America possessed overwhelming leverage. The public pitch suggested economic dominance was within reach. China did not respond with panic or immediate concessions. Instead, Beijing replied with measured, targeted actions. They sharply reduced purchases of American soybeans. They restricted exports of rare earth minerals, materials essential for smartphones, electric vehicles, and advanced military systems. They limited shipments of tungsten, a metal critical to American defense and aerospace production, where China controls roughly 80% of global supply. The immediate impact fell hardest on American farmers, rather than financial centers. Soybean exports to China dropped by 75% in 2025. Not a modest decline, but a collapse. Total sales reached only $3 billion, the lowest figure since 2018. Farm bankruptcies across key states rose 46% in a single year. Families who had planned crops around established markets suddenly faced closed doors. The consequences were concrete: missed payments, lost revenue, and generational farms at risk. Meanwhile, China adapted. In 2017, the United States supplied about 60% of China's soybean imports. By 2025, Brazil and Argentina provided 80%. China had quietly rebuilt its agricultural sourcing networks during the dispute. Brazil gained permanent market share with little interest in yielding it back. This permanent shift forms the true context for the $17 billion agreement. Once you see it, the numbers look quite different. Examining the celebrated figure. The administration returned from Beijing highlighting $17 billion in annual Chinese purchases of American agricultural goods through 2028. Officials described it as a major achievement and a strong outcome. Let's review that number with clear eyes. In 2024, before tensions peaked, China already purchased $24 billion in American farm products. In 2022, the figure reached $38 billion. The new commitment therefore represents less than half of recent historical levels. The trade measures did not simply create temporary pain. They altered baseline relationships. The recovery agreement does not restore previous volumes. It resembles rebuilding part of a damaged structure and presenting it as full restoration. Another important detail: the $17 billion does not include soybeans, traditionally the largest single category worth around $12 billion annually. Those were addressed in a separate October 2025 arrangement. Combining both brings the total closer to $27 billion, still below pre-dispute peaks. China has also fallen short on previous soybean commitments. Recent data shows purchases below targets and actual shipments even lower. This pattern echoes the 2020 Phase 1 agreement, where China met only 58% of promised purchases. When analysts describe the new deal as returning to Phase 1 levels, they are aiming for the outcome of an earlier agreement that under-delivered. That is the current benchmark being called historic. The Boeing announcement followed a similar pattern. China agreed to purchase 200 aircraft. Boeing's stock fell 4% on the news. Analysts had anticipated closer to 500 planes. Markets viewed the same development as falling short of expectations, while officials celebrated it. Two different interpretations of identical facts. What the other side gained. Every negotiation involves trade-offs. American coverage focused heavily on perceived gains while giving less attention to what China secured. President Xi Jinping hosted the first visit by a sitting American president in nearly a decade. He received images of America's leading technology executives arriving on the presidential aircraft and meeting on Chinese soil. Those visuals, broadcast widely across Chinese media, sent a clear message domestically and internationally. America came to the table in Beijing. That imagery carried significant political value at no direct cost, but the more substantial outcome involves longer-term positioning, particularly around issues that could override the entire agricultural agreement. The costs that rarely make headlines. American households have felt the effects directly. Average tariffs on Chinese goods have risen from 3.1% before the earlier disputes to nearly 48% today. This represents an effective annual cost increase of about $1,500 per household through higher prices on everyday goods. These are not payments collected from China. They are borne by American consumers. The trade deficit the policy aimed to reduce showed minimal improvement. The overall deficit declined by just $2.1 billion in 2025, while the goods deficit actually increased by $25.5 billion. Meanwhile, federal support for affected farmers is projected to rise by $34 billion in 2026, meaning taxpayers are helping offset losses created by the same policies. Legal foundations have also shifted. The Supreme Court ruled 6-3 that parts of the tariff approach exceeded presidential authority. Temporary measures were enacted under different statutes, but the underlying legal structure remains uncertain. Chinese negotiators understand these constraints, the Taiwan factor that could change everything. During the summit, while trade details were discussed, President Xi delivered a direct message. He stated that any mishandling of Taiwan could lead to serious clashes and endanger the entire relationship. This was not standard diplomatic language. It was a clear boundary drawn during active negotiations. At the same time, discussions emerged about using a pending $14 billion U.S. weapons package for Taiwan as potential bargaining leverage. Congress had previously approved an $11 billion package, prompting Chinese military exercises around the island. The stability of agricultural commitments, aircraft orders, and broader frameworks may depend on how sensitive Taiwan issues are managed. A single misstep could render the economic agreements meaningless. The two sides also released differing readouts of the same meetings. The American version emphasized specific commitments. The Chinese statement spoke more generally about ongoing discussions. Such gaps often indicate that final terms remain subject to interpretation. The technology dimension that tariffs cannot resolve. Parallel to trade talks, restrictions on advanced chips prompted China to accelerate domestic semiconductor development. Billions poured into self-reliance efforts. China now leads in older generation chips and is advancing faster than expected in more sophisticated areas. Policies intended to slow progress instead accelerated local capabilities. Similar patterns appeared with rare earth minerals. China dominates supply chains for materials critical to electronics, vehicles, and defense systems. During heightened tensions, export restrictions highlighted strategic vulnerabilities. The summit produced general commitments to address concerns, but without detailed timelines or enforcement. The larger picture. Without the disputes that began years ago, U.S. exports to China might have been 60% higher in 2025, representing nearly $90 billion annually. Over a decade, cumulative losses approach $1 trillion, with farmers, manufacturers, and consumers bearing most of the burden. The trade deficit showed little meaningful change. The Beijing framework includes useful new dialogue channels and market access improvements for certain products. These represent tangible steps. However, announcements and actual sustained results have often diverged in past agreements. Delivery will depend on consistent purchases, stable Taiwan relations, and legal clarity around tariffs. The United States approached the summit from a position of economic strength, but left with commitments below previous baseline levels. The central question is whether the strategies that created the losses can effectively restore the lost ground. The trade tensions have not ended. They have entered a more complex phase where public statements and private realities may continue to differ. If this analysis went deeper than standard coverage, hit like and subscribe. Turn on notifications for more data-driven examinations of global economics. Share with anyone who viewed the $17 billion headline as a clear resolution. What are your thoughts? Do you believe China will follow through on the agricultural commitments this time around? Let me know in the comments.